Hello everyone. Today we are going to talk about valuation of bonds and stocks. This is chapter 5 of our book Business Finance 1. My name is Gülşah Kulalı, and today we are going to calculate the value of a bond and understand the relationship between market interest rate and value of a bond, and then understand the relationship between a bond's coupon rate, yield to maturity, and current yield. Third, we are going to see how the calculations of value of a stock using present value of future cash flows and different methods of calculating stock value. And last, we will talk about calculations of expected rates of return, capital gains yield, and dividend yield of stocks. I want to start with a bond, definition of bond. Bond is a type of debt security, which means that it represents borrowing by the issuer. However, rather than getting a loan from a bank or other financial institution, the bond allows the funds to be obtained from a large number of parties under common standardized terms. They can usually only be issued by governments or large well-known firms. Bonds obligate the issuer to make specified payments to the bondholder on specified days over a specified time period. As you can see, it is a kind of standard security that the protection of investor is considered by the government or by administrative parties, because there is an obligation of a borrower to pay the specified payments to the investor. If it doesn't pay, so the money of an investor would be a loss. So especially small investors should be protected by the agencies. So it's a debt, and in the balance sheet, the issuer records bonds to its liabilities, and investors should record this bond to its assets, short-term or long-term assets. And this line here represents the time and years from 2018 to 2023. There are 15 Turkish liras or $15 payments here, and here in this example the principal amount is $100. So interest rate is 15%, and each of the 5 payments is called coupon payments, and if not specified as other terms, it is made yearly. Each year borrower pays $15, and in the end of the period, in the end of the 5th period, together with 15, bondholder repays principal, which is $100 in this example. When we want to value a bond, we want to take everything to the present, because we make decisions today about buying or not buying, or selling or not selling. So we have to find the present value of future cash flows from our investment. So we put ourselves in the place of an investor, and we want to invest our $100, and we want to find out that what is the present value of my investment if I buy this bond. So like any other valuation, a value of a bond is the present value of future cash flows. Future cash flows to an investor are these interest coupon payments, and in the end $100. So we want to use the techniques that we learned from the chapter time value of money. We talked about how can we find the present value of a future cash flow. So we find the present value as 107. Here you can see 5 of the $15. There is a small error here. The last one should be 115, not just 15. So please correct that error in the book or in our slides. And there is a connection between the interest rates and bond values. As you can see, there is a opposite relationship between them. When interest rates get higher, bond price get lower, and vice versa. When the market interest rate is equal to the coupon interest rate of a bond, bonds sell at their par value. It is the face value, that is the value written on the bond. When the market interest rate is below the coupon interest rate, for example, in our example, it was 15%. When it goes down to less than 15%, then bonds sell above their par value, and they are called premium bonds. When the market interest rate exceeds the coupon interest rate, bonds sell below their par value, and they are called discount bonds. We have another concept, that is yield to maturity. It is the average rate of return that will be earned on a bond if it is bought at the market price and held until it matures. It is the discount rate that makes the present value of future cash flows equals to its market price. It is like an internal rate of a bond. So in this figure we see the gray line here. This is a par value, and if we have bond price bigger than a par, then we call it a premium bond, and if it is less than a par value, we call it a discount bond. And in this figure we see that the price of a bond is get higher and higher if it is a premium bond. When years to maturity gets higher, it means when the maturity is longer, so price of a bond gets higher. But for the discount bonds, when the maturity gets longer, the price of a bond gets lower and lower. Here we have another concept, that is bond ratings. There are maybe you see in the newspapers or in the internet that there are some rating agencies. The biggest two is Standard & Poor's. Here we have S&P for that, and there is another agency that is Moody's. They rate the issuer companies of bonds. That it means that if they give you AAA, AAA, it means that rated AAA has the highest rating. Capacity to pay interest and principal is extremely strong. Risk is so low, default risk is so low, and the capacity to pay is strong. So these ratings show us capacity of payment of interest and principal. And if it is BBB for Standard & Poor's, it means that having an adequate capacity to pay interest and repay principal, whereas it normally exhibits adequate protection parameters, adverse economic conditions or changing circumstances are more likely to lead a weakened capacity to pay interest and principal. And we have C there. It means that it is for income bonds on which no interest is being paid. And D is the worst rating. If D, it means it is in a default and payment of interest and or principal is in errors. So companies try to get higher ratings from these agencies because they want to issue more bonds. If the rating of a company is so low, then nobody wants to buy their bonds. Nobody wants to lend their money to this issuer company. So it's kind of a life changer for companies. Our chapter is about bonds and stocks. Let's talk about stocks. If you purchase stock of a company, then you become an owner of that company. This is a very distinction of stocks and bonds. If you are an investor and if you buy a stock, then you will become an owner of a company that you have some shares. But if you buy bonds rather than stocks, you are not going to be the owner of the company. You will be just be the lender of a company. We call it as creditor. You just give some credit to this company and the company will repay you the principal and pay you the interest payments. But in stocks, there is no specified repayments from a company. There is no specified dates and specified exact amounts of money that you will earn. Stock ownership provides rights to vote, to receive dividends, to share in residual in case of dissolution, and a preemptive right to prevent undesired reduction of ownership share. If we talk about valuation of stock, we have to think that is again the present value of future cash flows. This is not changing. So, what is the potential future cash flow of a company? There are two kinds. First one is dividends. If a company will pay you some dividends, then it will be your, as an investor, it will be your cash flow. At the same time, and there is one more cash flow, which is called capital gain or capital loss. If the purchase price is, for example, $3, and if it will if it is $5 when you want to sell your stock, then $2 is your capital gain. On the other hand, if in the selling date of your stock, if the price is $2, then $1 is your capital loss. So this capital gain or loss and dividends are discounted at a rate that is your expected rate of return from this investment. We will find the value of our stock. This chapter is all about valuation and finding present value of some future cash flows. I hope this video is helpful for your studies.